All right. Welcome to your deep dive. You ready to put this trading system through the ringer, huh? Smart move. So we've got your analysis documents here. And let me tell you, they are packed with data. We even spotted some Thai financial terms in there. So somebody's been doing some serious digging.
Sounds like it.
But here's the thing about all these numbers.
Yeah.
It's easy to get lost in the weeds, right? You miss the forest for the trees.
It really is like having a treasure map but no idea which X marks the spot.
Exactly. So today,
Yeah.
we're going on a treasure hunt. We're going to sift through these metrics, separate the gold from the fool's gold, and help you decide, is this system worth your time? And trust me, you'll learn some tricks along the way to avoid some common traps that even, seasoned traders can fall into. For example, you might think a system with a sky-high win rate, that's a guaranteed winner, right?
Not so fast.
Oh.
Not necessarily. Imagine a system that wins like 90% of its trades. Sounds amazing on the surface, right?
Yeah.
But what if those wins are tiny? Just scraping by. And then that one loss out of 10 is a massive wipeout. Suddenly that 90% win rate isn't looking so hot anymore.
Ouch.
Yeah.
That's a painful lesson to learn the hard way.
It is. That's why we need to dig deeper. Look beyond just the surface level stuff.
Yeah.
And understand the real drivers of profitability.
Okay, so where do we even begin?
Well, it all starts with what we call the key performance metrics. These are the numbers that really tell the story of a trading system's success.
Okay. Key performance metrics. Let's unpack that. What are the metrics we absolutely have to understand?
Super.
And what are some of the common pitfalls to watch out for?
The first thing to keep in mind is that your software or your broker, they might give you some generic guidelines, but those can be seriously misleading. They're kind of like those one-size-fits-all clothes, Might look okay on the rack, but rarely fit you perfectly.
Yeah, I feel that. So we need to tailor those metrics to our own needs and the specific market we're trading.
Absolutely. Let's start with one that's often misunderstood. Drawdown. This is the biggest potential loss the system could produce. And here's the thing. It's not just about finding a system with the lowest possible drawdown. It's about finding a drawdown that you can handle psychologically.
Okay, interesting. I've heard some traders say they aim for a drawdown of less than 10%.
Okay.
Is that a good rule of thumb?
Not really, no. You see, for some traders, a 10% drawdown might feel like a walk in the park.
Right.
But for others, it could be a scoopless night. Every time the market dips, even a little, it all comes down to your risk tolerance and how much volatility you can stomach. It's like choosing a roller coaster. Some people, they love that adrenaline rush, that steep drop. Others prefer a more gentle ride.
Yeah, great analogy. So finding the right drawdown, it's about matching the system's risk profile to our own comfort level.
You got it.
Got it. Okay, drawdown check. What else is on the list? What else do we need to be paying close attention to?
Well, the big one, obviously, is net profit. But here's the catch. You can't just look at the raw number. You need to annualize it. Basically figure out what your return would be over a full year. This way you can compare apples to apples with other investments, like stocks or bonds.
Right. So instead of getting all excited about a system that made, say, $10,000 in a month, we need to figure out what that translates to over a whole year.
Exactly. And remember, net profit is all about gains minus losses. It's not just how much you win. It's about how much you keep after those inevitable losing trades.
Right. Because even the best traders in the world have losing trades. Right. It's part of the game. So we've got drawdown, we've got net profit. What's next on our metric checklist?
Win percentage. Now, we already talked about how a high win rate can be a little deceiving, but it's still an important piece of the puzzle. A consistently low win rate, say below 40%, might indicate that the system's logic is flawed, or that it's not adapting well to market conditions.
So it's not about chasing a specific win percentage, but rather understanding what that number tells us about the system's overall effectiveness.
Yeah, that's a good way to put it.
Okay.
And finally, we need to consider the number of trades generated by the system.
Okay, why is that? I mean, isn't a profitable trade a profitable trade, regardless of how many there are?
Well, think of it this way. Imagine judging a basketball player based on, 5 shots. They might get lucky and single 5, but that doesn't make them Michael Jordan, right?
True.
You need a larger sample size to see their true skill level.
So a system with only a handful of trades could just be riding a lucky streak.
Exactly. We need enough trades to be statistically confident that the system's performance is repeatable, not just a fluke.
Okay, that makes sense. So how many trades is enough? Is there a magic number?
Unfortunately, no. There's no one-size-fits-all answer. The ideal number of trades depends on the market you're trading and the time frame of your analysis. If you're trading a fast-moving market, like Forex, on a short time frame, you might need hundreds or even thousands of trades to get a reliable picture. But if you're trading a slower market, like long-term stock investing, a smaller sample size might be sufficient.
Got it. So it's all about context. We need to tailor these metrics to the specific market we're analyzing.
Precisely. And remember, these are just FUW of the key performance metrics to consider. There are many others, and we'll delve into some of those as we go.
Awesome. This is already starting to feel like a masterclass in trading system analysis, and we've only just scratched the surface. Now that we've got a good grasp of these key metrics, I'm ready to see how we can put them to use in testing our system. What's next on our deep dive agenda?
Well, now that we know what to look for, let's start putting that system through its paces. We need to see how it performs, not just on paper, but in different scenarios, and that's where testing comes in.
Okay. Sounds like we're about to get our hands dirty. Let's dive into those tests and see what they reveal about your trading system.
All right, let's do it. Or welcome back. We've talked about those all-important key performance metrics, and now it's time to see how your system measures up in the real world, or at least a simulated version of it. And that's where testing comes in.
Okay. I'm ready to put on my lab coat and start experimenting.
Great. Now, your analysis documents include a whole bunch of different tests, and each one gives us a different piece of the puzzle. Let's start with what's often called the in-sample basic test.
Okay, the in-sample basic test. So from what I understand, this is where we test the system on historical data. But what exactly are we looking for in these results?
Think of it this way. You've built a robot to play chess, and the in-sample basic test is like playing a bunch of games against a computer simulation. It gives you a baseline to see if the robot's basic logic is sound, and if it can, win games. But it's not the whole picture.
Okay, so it tells us if the robot can play chess, but not necessarily if it can beat a grandmaster. What's the equivalent of the grandmaster challenge in trading system testing?
That would be out-of-sample testing. This is where we take the robot out of the lab, and we pit it against real human opponents, in this case, the unpredictable movements of the market.
Okay, so that's where we see. If the system can hold its own in the wild, but wouldn't that mean testing it on future data, which is impossible, right?
Well, we can't predict the future, but we can use a portion of historical data that the system has never seen before. It's like giving the robot a new set of chess games to play against opponents it hasn't encountered before.
Got it.
Correct.
So how do we know if our system passes this out-of-sample test? What should we be looking for?
We want to see how those key performance metrics we talked about earlier,
Right.
how they hold up in this new unseen data. Does the net profit drop significantly? Does the win percentage plummet? Does the max drawdown exceed our comfort level? These are all red flags
Right.
that the system might be over-optimized to the in-sample data and not truly adaptable to different market conditions.
Over-optimized, meaning it's like a student who only studies for a specific test and then bombs the final exam because they haven't really mastered the material.
Perfect analogy. Over-optimization is a trap that a lot of traders fall into. They tweak and adjust their system until it performs perfectly on historical data, but they haven't really built a robust system that can handle the unknowns of the market.
So out-of-sample testing is all about exposing those weaknesses and seeing if the system can truly adapt.
Exactly. Now, beyond those basic tests, your analysis documents also include some more sophisticated techniques like sensitivity analysis and Monte Carlo simulation.
Okay, those sound a little intimidating. Break it down for me. What's sensitivity analysis all about?
Remember how we talked about slippage? Those pesky little price discrepancies that can occur when you actually execute a trade? Well, sensitivity analysis is where we test how much those slippages or other factors like stop-loss orders can impact the system's performance.
So we're essentially stress testing the system, seeing how much it can bend without breaking.
Exactly. Imagine you're designing a bridge. You don't just want to know if it can hold the average weight of cards. You want to know if it can withstand strong winds, heavy traffic, maybe even an earthquake. Sensitivity analysis is like that for trading systems. We're seeing how much stress it can handle before it cracks.
Okay, that makes sense. And what about Monte Carlo simulation? That sounds pretty high-tech.
It is. But don't worry, it's not as complicated as it sounds. Imagine flipping a coin 100 times. You might get heads 60 times and tails 40 times. But if you flipped it another 100 times, you might get a completely different result. The Monte Carlo simulation is kind of like that. It's like flipping that coin thousands of times. But instead of heads or tails, We're looking at different potential market scenarios.
So it's basically creating a bunch of what-if scenarios
Mm.
to see how the system performs under different market conditions.
Exactly.
That's pretty clever.
And what's fascinating about the Monte Carlo simulation is that it can be incorporated into other tests, like the in-sample basic test and the sensitivity analysis.
Okay, I'm trying to picture this. How does that actually work?
Let's go back to our bridge analogy. With the in-sample basic test, we're seeing if the bridge can hold a certain weight. But with the Monte Carlo simulation layered on top, we're not just testing one specific weight, we're testing a range of weights, from light traffic to a full-blown traffic jam, to see how the bridge responds under different stress levels.
So it's like adding another dimension of analysis,
Yeah.
taking into account the randomness
Yeah.
and the unpredictability
Yeah.
of the market.
Precisely. And this gives us a much more realistic and comprehensive view of the system's potential strengths and weaknesses.
This is starting to feel like a masterclass in risk management as well. By simulating all these different scenarios, we can get a much better sense of the system's true risk profile.
Yeah, absolutely. The Monte Carlo simulation helps us understand not just the average outcome, but also the range of possible outcomes, including those rare but potentially devastating events.
That's incredibly valuable information to have before putting any real money on the line.
For sure. And it highlights the fact that trading system evaluation isn't a one-time event. It's an ongoing process of testing, analyzing, and refining.
Okay, we've covered a lot of ground with these tests, but before we move on, you mentioned something in the source material that caught my eye. The Munger test. What is that, and how does it fit into all of this?
Oh, the Munger test. It's a fascinating concept, and it's all about challenging our assumptions. It asks a simple but profound question. Can our carefully crafted trading system actually beat a completely random strategy?
Wait, so we're comparing our system to essentially flipping a coin. That seems a bit harsh, doesn't it?
It might seem that way, but it's a powerful reality check. If our system can't consistently outperform randomness, then what are we really doing? Are we relying on skill? Or are we just getting lucky?
Okay, I see your point. That's a humbling thought. So how do we actually implement this Munger test using all these tools we've been talking about?
This is where the Monte Carlo simulation comes in handy again. We can run the simulation with two sets of parameters. One set represents our actual trading system, and the other set simulates random entries and exits. Then we compare the results.
So we're basically having a simulated showdown between our system and coin flipper. And if our system can't consistently come out on top,
then it's back to the drawing board. We need to refine our strategy, test new ideas, and keep searching for that edge that truly separates us from random chance.
That's a great takeaway. Always challenge your assumptions and never stop searching for that edge. But we can't forget about the time dimension, right? Markets are constantly evolving. So how do we know if our system can adapt to those changes?
That's a great point. And it brings us to another powerful technique, walk-forward analysis. Instead of testing the system on one big chunk of data, we break it down into smaller segments, simulating how the system would have performed over time.
So it's like time traveling.
Yeah.
Testing the system in different market eras to see if it can adapt and survive.
Exactly. And we can even combine walk-forward analysis with the Monte Carlo simulation to add that extra layer of randomness and get an even more comprehensive view of the system's long-term robustness.
Okay, my brain is officially full of trading system knowledge. I think I'm starting to see the big picture here. It's not just about finding a system that worked in the past. It's about building a system that's adaptable, resilient, and can handle the unknowns of the future.
That's a great way to put it. Now, before we wrap up, I want to emphasize one crucial point, the importance of critical thinking.
Okay, I'm all ears. What do we need to be mindful of as we analyze all these test results?
It's easy to get caught up, in the excitement of seeing positive results. But remember, no backtest is perfect. They're incredibly valuable tools, don't get me wrong, but they can't predict the future.
Right, so we need to view those results with a healthy dose of skepticism. What are some common pitfalls we should be aware of when interpreting all those numbers?
One of the biggest traps, and we touched on this earlier, is over-optimization. It's tempting to, tweak and fiddle with a system until it backtests flawlessly. But that often leads to a system that's, brittle, like a house of cards, that collapses when the market throws a curveball.
Yeah, I get that. It's like training a dog to do tricks only in your living room. It might look impressive there. But take that dog to the park, with all the distractions.
Yeah.
That's a whole different story.
Exactly. Robustness is key. We want a system that can handle the unexpected, not one that crumbles under pressure. And that's where critical thinking comes in. Don't just blindly accept those backtest results. Question them, challenge them, and look for potential weaknesses.
So we need to put on our detective hats and look for clues that might reveal hidden flaws in the system. What kind of clues should we be on the lookout for?
One thing to watch out for is a dramatic difference between the in-sample and out-of-sample results. If the system performs amazingly well on the data it was trained on, but then tanks on the unseen data, that's a big red flag.
Yeah. It's like that friend who's a rock star at karaoke,
Yeah.
but freezes up when they have to sing
Yeah.
in front of a real audience.
Exactly. Another thing to consider is the number of trades. We talked about this earlier, but it's worth repeating. A system with very few trades might be statistically unreliable. Those impressive results could just be a fluke, a lucky streak that won't last.
Right. It's like judging a restaurant
Yeah.
based on one delicious dish. You need to sample more of the menu to get a true sense of the chef's skills.
That's a great way to think about it. And finally, be wary of unrealistic expectations. No trading system is perfect. There will always be losing trades, and there will be periods of drawdown. The key is to find a system that you can comfortably trade, one that aligns with your risk tolerance and your financial goals.
Right. It's all about finding that sweet spot between profit potential and risk management. We can't eliminate risk entirely, but we can manage it intelligently.
Yeah.
Now, before we wrap up this deep dive, you mentioned something about market classification. Can you explain what that is?
Yeah.
And why it's important for evaluating trading systems?
Sure. This is where we kind of take our analysis to the next level. Market classification is all about understanding that markets aren't static. They go through different phases, like bull markets, bear markets, and sideways markets. And a trading system that performs well in one type of market might struggle in another.
So it's like having different tools for different jobs. You wouldn't use a hammer to screw in a light bulb.
Exactly. Market classification helps us identify those different market regimes and tailor our trading systems accordingly. We can even develop multiple systems, each optimized for a specific type of market, and then switch between them as conditions change.
Wow, that's pretty sophisticated stuff. It's like having a team of specialized robots,
Yeah.
each programmed to excel in a different market environment.
It is. It's a more nuanced approach to trading system development, but it can be incredibly powerful. And it highlights the fact that trading isn't just about following a set of rules. It's about understanding the dynamics of the market and adapting to change.
This has been an incredible journey through the world of trading system evaluation. We've covered so much ground, from understanding key performance metrics to exploring sophisticated testing techniques and even dipping our toes into advanced concepts like market classification. I feel like I've leveled up my trading knowledge significantly.
That's great to hear. But remember, this is just the beginning. The real learning happens when you apply these concepts to your own trading, when you start testing, analyzing, and refining your own systems.
You're absolutely right. We've given our listener the tools and the knowledge. Now it's up to them to put it all into practice. But before we send them off on their trading adventure, I have one final question for you. You've emphasized throughout this deep dive the importance of critical thinking and adapting to change. But the future is inherently uncertain. How can our listener prepare for the unexpected, for those black swan events that no backtest can fully anticipate?
That's the million-dollar question, isn't it? And there's no easy answer. But here's what I would suggest. Never stop learning. Never stop questioning your assumptions. And always be prepared to adapt your strategies as the market evolves. The best traders aren't those who find the perfect system. They're the ones who are constantly learning, evolving, and staying one step ahead of the game.
That's a powerful message to end on. Trading is a journey of continuous learning and adaptation. And with the tools and the knowledge we've shared today, I think our listeners are well equipped to navigate that journey and achieve their trading goals. Thank you for joining us on this deep dive. We'll see you next time.